We've actually had a flat year on a like-for-like basis, and we're actually quite pleased with that result. Our underlying income has grown 8.5% on a net interest basis and just over 15% for our non-interest income, giving an overall increase of about 10%. So the underlying business, we think, is in very solid shape. The reason that the profits came out flat was partly due to capacity building initiatives, which have increased our non-interest expense by close to 15%. And as you mentioned, a rise in provisions for doubtful loans. This is part and parcel of the slowdown that's occurring everywhere. As you know, Europe is in recession, India's slowing down, China's slowing down, America is struggling with growth. And the economic climate is somewhat subdued everywhere at the moment, and this is clearly affecting a small niche economy, which Mauritius is. It's a $10 billion GDP economy, 1.2 million people, with a quite strong exposure to tourism coming from Europe and textiles being exported to Europe. And a number of companies are having to grapple with this slowdown. So we think it's part and parcel of the business cycle, and that companies do adjust, they do adapt, they trim their cost base, they look for replacement markets. So even though our problem loans have spiked up a little bit, we don't think it's anything to be unduly concerned about. All of our lending is done on a fully secured basis, so we have charges over assets or over the undertaking of companies, and where that collateral is insufficient to cover the loan exposure, then we increase our provisions, and that's what's happened this year. That does not mean that we're going to lose the money. We think that the lending is in general pretty solid, and that companies are experiencing what I call this adaptation difficulty because of the slowdown in the economy everywhere. So we've been through these phases before, and we've come through them extremely well, and we don't think that this current downturn will last longer than hopefully another 6 months, possibly a year. But it is clearly a challenging economic environment for a lot of companies that are having to amend their business models and adapt their cost base to a slower rate of growth of revenues, or in some cases flat revenues. But as far as the bank is concerned, our underlying business is in very robust shape. It's growing. The capacity building initiatives, which were to replace our IT platform, to refurbish all our 40 branches, and we built a big new building, energy conscious building in Mauritius. That's all done, that's completed. So whilst the depreciation associated with these capacity building exercises hit us for the first time this year, it is fixed. And so as we grow the revenue in years to come, we hope that the cost income ratio will start to come down to the levels which are normally associated with MCB.
Now, speaking of growth, I mean, you currently have operations in the Seychelles, Madagascar, Mozambique.
Yeah.
Are there any other places in Africa that you're looking to expand into? We're seeing a big rush towards countries like Rwanda, Tanzania, and Uganda. Are we going to be looking at just organic growth, or are we going to be seeing more strategic alliances or acquisitions?
Our strong preference is for organic growth. We have a bank-for-bank strategy, which is proving to be quite successful. We are doing trade finance business with about 20 sub-Saharan African countries, and the top 10 banks, about 120 banks in all. This trade finance business is proving to be quite interesting in the sense that all of the economies in sub-Saharan Africa in general are growing 5%, their GDP by 5% a year, and have done for the last few years and look like they will do for the next few years. They need, therefore, trade finance in order to import key commodities like oil, for transportation, for electricity generation, etc. And we have a role to play in confirming these letters of credit. And what's not generally recognized is that there's been a fall-off in the limits that European banks and American banks make available to African banks and African countries. And therefore this has created a space into which MCB has moved in its modest way to try and mitigate this decline in the supply of trade financing lines to African banks and African countries. And therefore it's proving to be quite an interesting business line for us, and we think it's got a lot of potential development, because a lot of these European banks are grappling with unknown valuations of their sovereign bonds that they've purchased from Spain and Portugal and Ireland and Greece and Italy, which are the four worst affected countries. But they're also struggling to meet their 9% capital ratios. Very few of them are raising new capital to meet this Basel III requirement. They're trimming their balance sheets, which is why they're chopping out lines and exposures to not just African countries but emerging markets everywhere, because they generally carry higher risk weights. So it's more helpful for them as they strive to meet their 9% capital ratios. I don't think they're going to return in any size for quite a few years, so that's why this is such an interesting opportunity for the MCB. Mauritius is a member of SADC, it's a member of COMESA, it's a member of the Eastern African Community, all of which are increasingly important regional groupings. All of these economies are growing at 5% plus, as we know. Then collectively, the size of these economies is much larger than Mauritius, so it's giving Mauritius Commercial Bank a very interesting opportunity to participate in the economic growth and supply much needed trade financing limits.